Hey everybody, welcome back to the Mustard Seed podcast. This week I have on Pierre Rochard. Pierre, welcome.
Hey Joe, thanks for having me on.
Absolutely. Pierre, I want to ask you, starting with just the entire Bitcoin Treasury Company space, do you think the Bitcoin Treasury Company space or corporate Bitcoin adoption is becoming too competitive or too crowded, or what do you think about the current state of things?
Yeah, great question. I think that no is the first answer. I think that we need more Bitcoin treasury companies, but I think that there will naturally be market cycles where when valuations are depressed, people will try to find scapegoats of, oh, there's too much competition, or this was never going to work to begin with, and people are doing it wrong. So I think that might be where we're at in sentiment wise. But if I zoom out over the coming decades, I think that the more companies start adopting this strategy today, the better in the long term. And something else that I've heard, I think Saylor has expressed this view sometimes, which is that on social media, you kind of have to be careful about is this account long short dated call options, or are they long the stock long term, not to use the double long there. And so they're going to have different views on what companies should be doing, where the industry is at. So that's where I fully agree that you gotta zoom out.
Yeah, it seems like strategy in particular, I mean, a lot of Bitcoin treasury companies, but, everyone kind of got really mad about the mNAV guidance that Saylor issued and then kind of adjusted slightly. I'm curious, do you have a perspective on that?
Well, so there was, and I think there will continue to be a debate about how much influence does a company's capital markets activity have over the mNAV. And I think that for the most part, the mNAV is really a market signal. It's a market price that is not set by the company, and that it's set by the traders, and who are negotiating what the company's valuation ought to be relative to its Bitcoin holdings, and that it's an input for the company to make decisions based on their mNAV, and that making decisions to try to influence the mNAV is like wagging the dog, right? And so putting out that guidance and then kind of walking it back, I think it was actually good and valuable to try to help educate the market about how much influence does the management team have over the mNAV, and showing that, hey, look, we can put out guidance about the mNAV. It's not going to suddenly cause it to change, right? It's not like the Fed funds rate, where you change the interest rate, or like the stretch interest rate, which they did just increase. So I think the mNAV is really the product of what are the market's forward expectations for Bitcoin's upward volatility, right? Do they think the Bitcoin price is going to go up violently or not? And that right now we're in the doldrums. And so I think volatility is suppressed. Bitcoin price is down from the all-time high 2 weeks ago, which, says if we're not hitting an all-time high like every day, then sentiment is really negative.
Mm-hmm. Yeah. What do you think about I've heard people suggest that, at a certain point, I mean, like logically, if strategy held all 21 million Bitcoin, that would be a problem. Is there a certain point at which Saylor accumulates just too much Bitcoin? I've heard him say in the past, which I think I might agree with this, where he's like, at $1 million per Bitcoin, maybe that means they own, 5% of the supply or something like that. And then maybe at $10 million per Bitcoin, maybe they own 10% of the supply, or 7.5%, something along those lines. From your perspective, is there a point at which strategy is accumulating too much Bitcoin?
So This is a great question because I believe currently the coins that people think Satoshi Nakamoto has far exceeds what Strategy currently has. In terms of like threshold, they're not number one as far as we can tell right now. Contrary to what the Monero bros say, Bitcoin has pretty good privacy. We actually don't know if all those coins belong to Satoshi or not, or if the keys have been destroyed, right? But once he gets past that, it's an interesting question because if we follow the Manhattan metaphor of you're buying land on the island of Manhattan, does owning 100% of the island of Manhattan reduce the value of the land? And you could argue no, because you're still at a strategic geographic point, shelling point, that is still very desirable for, where it is. But you could also argue yes, in the sense that now you don't have other developers like providing, essentially complementary goods that would actually increase the value of your land. And so we're still very far from that. And I could argue that 10, 15, 20, 25% ownership of the UTXO set, totally fine. It really is, if we're going to draw some conclusions from if they were to reach that point, it would be about the paper hands of the OGs that, wow, how much did they really believe in, in Bitcoin if they gave up their coins so quickly? But also that it would be a real condemnation of Strategy's competitors in the Bitcoin treasury space if he really, got so far ahead, and it's on everyone in the industry to be executing to prevent that from happening. It's virtuous competition. But yeah, I don't think that that's like a huge concern today, given where they're at.
Yeah, I completely agree. And you made a point about the other Bitcoin treasury companies. I find it. I'm curious if you agree. Like, I find it so interesting that the other titans of industry, whether that's banking, technology, oil and gas, or whatever. As far as I know, there was never another titan of industry that published his playbook, encouraged all of his competitors to copy his playbook, and still there's hundreds of Bitcoin treasury companies at this point, but broadly the entire public equity market is not copying his strategy. Why do you think that is, and what are your thoughts on that?
Yeah, well, so I mean, if you look at the history of the Industrial Revolution and whatnot, I don't think that there was a lot of dominance that was driven just by the secrecy of their playbook. I think that there was definitely. I've read stories about Standard Oil playing games of to crush their competition, but it wasn't because they had trade secrets about the refining of oil into gas. It was more at a tactical level of buying out competitors and also buying land in particular locations, cut off competitors and whatnot. But then the other part of it too is there's lots of natural monopolies that emerge. For example, AT&T, or telephones and electricity, where you get network effects that really give you a huge advantage. And I do think that Strategy benefits from some serious network effects about the liquidity of the common stock, the emerging liquidity of the preferreds, the liquidity of the options chain on the common stock. And so I think those are very real network effects. And that that gives them a moat that is hard to replicate. But sorry, what was the second part of the question?
Just are you surprised that others have not copied Saylor to the same degree?
Yeah. No, I think that's the innovator's dilemma. So they've already got a successful business. They can't just go leverage long Bitcoin. To them, that would be like, and we've even heard people like Brian Armstrong, the CEO of Coinbase. He's like, oh, I'm not running a hedge fund here. Okay, I can't just like go long an asset. And so that's the kind of thinking that they approach it with. And I think that does mean that Saylor gets to dominate and not have to worry about Apple or Amazon coming in with much greater operating cash flow to leverage up against and to really buy a lot of Bitcoin.
Yeah, good point. I know the ETH community has been kind of loud lately in Bitcoin terms. They had a couple good weeks, I think, at this point. Maybe not recently, but a couple weeks before maybe the last few days or so. I haven't seen the exact price, but they're excited recently. And one of the points that they keep bringing up against the Bitcoin community is the idea of the security budget. I know, like, we've talked about it before, and we wrote a paper about it a few years ago as well. But for those that might be concerned about the future security of the Bitcoin network, how are you thinking about that long term as the block subsidy dwindles towards zero?
Yeah, so great question, and one that we've explored together in the past. I think that first, where did this concept come from? It really, I think, did originate from researchers who had motivated reasoning that they wanted to reach a certain conclusion. Because if you look at Satoshi Nakamoto's white paper, pretty offhanded comment. He's like, the transaction fees will take over from the subsidy. Now, I think that as the incentive for mining blocks, but I think that that morphed into a lot of confusion about what contributes to transaction finality. So personally, I don't think that the subsidy contributes to transaction finality. I think that the subsidy on day zero had two purposes. One was getting units onto the ledger, so moving them out of the issuance schedule and into the UTXO set in a way that is competitive, so that you avoid the problem of monopoly profits from the issuance. And so in Ethereum's case, the monopoly profits from the issuance went to the Ethereum Foundation in order to finance the further development of Ethereum, right? So Bitcoin doesn't have that. And I think that that's a good thing. I like that every Bitcoin that is spendable in the UTXO set got there through the proof of work, permissionless process. The other reason that Satoshi points out in the white paper, and why it's called the subsidy, is to really attract early adopters. And so to get them to be interested in Bitcoin, which was a completely new concept in 2009. People lose sight of that, I guess. But back then it was, and to give them something to work for, right? And to run a node and to use that node with the built-in mining functionality at the time, to generate coins, as it was called back then. And that then the question was, okay, well, with regards to transaction fees, well, I think transaction fees serve a completely different purpose. So transaction fees are not about issuing new tokens onto the ledger, obviously, because they come from existing Bitcoin that are being spent. And they're very small compared to the subsidy. So on day zero, there was no transaction fees because nobody was transacting, and so it wouldn't have provided an incentive for people to get interested in downloading the software and running it. And so what the purpose of the transaction fees is really about to pay block producers to include your transaction in the block, in particular because each block has a limited amount of real estate on it of back in the day it was 1 megabyte. Now it's up to 4 megabytes. So thousands of transactions per block can fit in there, not millions. And so when a block producer, a mining pool is creating a block template of transactions, they're going to rank order them by the highest fee rate. So who's going to pay me the most per byte of data that I'm including in this block? And that's the purpose of the transaction fee is to get included into the next block. And there's not really any other purpose to it than that. Now, when people talk about the security budget, it becomes a very confused topic, because then what they're really talking about is transaction finality, which is about transaction fees, and has nothing to do about the subsidy, because a Bitcoin miner could censor all the transactions and still pick up the subsidy. So that's not part of the opportunity cost. So that's not really part of the security budget at all. In fact, you could argue that it subtracts from the security budget because now they are less sensitive to missing out on transaction fees because they're getting this other source of revenue, the subsidy. Furthermore, when and I know that, Joe, you're an accountant as well. When we talk about budgeting, we're talking about the future. When we look at the past, we talk about actuals versus budget. And when actual costs are below budgeted costs, that is good, right? That's what you want. That means that you have more profit. Now, in Bitcoin's case, when the transaction fees are the historical transaction fees are lower than what people expected, I think that's a good thing, because that actually means that the users of the system, the people who were sending transactions, got more value at a lower cost. And so they got the same amount of transaction finality, right? Because none of the transactions have been reversed or reorged out or censored or double spent. And they didn't have to pay as high of a transaction fee. So when people say, oh, historical transaction fees have been too low, my reaction to that is, well, are you saying that because you're a Bitcoin miner and you wanted more revenues? Or are you saying that because you're very confused about how the system operates? And then going forward, we want the budget to be as low as possible, right? We want to get, for a given amount of transaction finality, we want to spend as little as possible. And the reality is that if the finality is not being contested by an attacker or by network congestion, right, of lots of people wanting to send Bitcoin at the same time, then there's no reason to have high transaction fees. Another metaphor is like, do you want to have a standing army defending your border where you're spending trillions of dollars on people and tanks, patrolling the border to just in case there's an enemy invasion at any minute? Or do you want to have more of a, Minuteman militia style response of guerrilla warfare of, hey, if somebody invades, then we will dial things up, and we're not going to waste a ton of money on constantly, pouring it into the military industrial complex. And so I think that, Bitcoin's design is really very much the latter of, hey, we're only going to bid up transaction fees if there's an attacker. If there isn't, why waste resources? Why ask users to subsidize Bitcoin miners when there's really no objective reason to do so? Because at the end of the day, Bitcoin mining is permissionless. So it's not like if 100% of the hash rate gets captured by attackers, that there's no way for us to ever add more hash rate to beat them. It's an open set. So they can't exclude new hash rate from entering.
Yeah, I think that was very well said. Do you think, a large portion of the Bitcoin community even understands or has the same perspective as you? Because I feel like, over the years, people have, even I think you and myself probably have gone back and forth like, oh, like eventually we do need, large transaction fees to make the network sustainable. I think many people even today might have that position. do you think we know how this is, like everyone, in the Bitcoin community understands how this system is going to work or does work and is going to work? Or do you think it just kind of exists and we're like trying to comprehend like why it's working?
Yeah, so I've definitely changed my view on this over time. 10 years ago, I had the normie security budget view, and it's only with the halvings that happened, and then seeing kind of the volatility spikes in transaction fees and what happened in response to them, and seeing that, oh well, sometimes we're settling trillions of dollars of value with very low transaction fees. Like there's no correlation between the amount of value being settled and the transaction fees. There's only correlation between the backlog of transactions trying to get into the next block and the transaction fees, because that's the causal mechanism. And so when this security budget question kept coming back up, it forced me to think about it more rigorously than I did at first glance, and kind of develop my own view, which is very much in the minority even within the Bitcoin community. So like I've discussed this with Bitcoin core developers, right? Where they're like not on the same page about this with me. I haven't heard any good counter arguments to it, and I really do try to seek that out. The academic literature is abysmal on this. It's just like they're like, well, assume there's no fee market, like, and then they come to their conclusions, and it's like, okay, well, there's no value in your conclusion because you assumed away like the solution. Oh, if there's no fee market, then we need to have inflation and we need to create more Bitcoin and not have any halvings. It's like, okay, well, that's not a useful conclusion to come to. So, it's a very heterodox, outside the mainstream view, and I think that it really taints all of the debates, even like the core versus knots debate about filtering and censorship. Like, my view is just offensive to both sides of the debate, so I try to stay out of it. But I also come to the conclusion that I don't even need to be in that debate because it doesn't matter. And so that's it's a really interesting and far-reaching kind of debate on the security budget.
Yeah, I agree with what you just said on the core versus knots. Like, to me, from what I've seen, it doesn't really matter. Like, this is kind of like just bickering, it seems like. Why do you think that this has like gotten so much steam, and like there's been so much like divisiveness between these like two niche communities?
So on the core side, they are optimizing in a vacuum for global consensus and for global efficiency, and that is it's very much like a academic computer science approach to it, where they want to ship defaults that really optimize for the health of the system as a whole. And I think that is a perfectly valid way to run the project, and that's what they're doing. On the knots side, they want to have essentially not optimize for the global maxima, but optimize for the local maxima. As the node operator, this is my hardware, this is my software. I want to configure it how I want to configure it for my own uses, and to say that the defaults should be whatever it works globally the best, is an infringement on my independence and individualism as a node operator. Also, totally valid way to run a project, totally fine. So I think that like one approach that I would advocate for that would offend everyone would be that have the defaults be what Core is suggesting of just essentially having policy be as close to consensus rules as possible. And so that does mean that open op return, JPEGs in your mempool, it's awful, right? And at the same time, make it so that whether you're a node operator choosing what to filter in your mempool, or a Bitcoin miner choosing what to filter in your block template, that there's some kind of plugin architecture that allows you to download a plugin, and you can download a plugin that filters out ordinals, or filters out OFAC addresses, or filters out whatever you want, right? And even say like, hey, in my mempool, I only want transactions that are relevant to me. So if I have unconfirmed transactions, like I want those in my mempool. If it's anybody else's unconfirmed transactions, I don't care. I don't want them in my mempool, right? Terrible for privacy, but look, like that might be what you're optimizing for because you're trying to minimize your RAM usage and you don't care about the kind of the privacy angle of it, of what. So anyway, what would be the effect of this? So let's say everybody in the United States is running the plugin so that they don't have any OFAC addresses in their mempool, and the mining pools that are here in the US that are operated by US companies, they have a plugin that filters out all the OFAC addresses from their blocks, right? But abroad, let's say in Iran or in North Korea, where they're mining Bitcoin, obviously they would not have those filters on because they're the ones who are on the list, right? And so they'd say, no, we're going to include those transactions. They might choose to filter out transactions that are, going to the U.S. Strategic Bitcoin Reserve, right? Like they want to filter out their enemies' transactions. And then they broadcast out the block. And then here in the US, then the question is, if you receive a valid block that has OFAC sanctioned addresses in it, do you, as a mining pool, do you try to build on top of it, or do you try to orphan it, right? Or do you try to like not build on top of it? And the game theory perspective is that you actually have to build on top of it. Otherwise, you're never gonna make any money. Just pragmatically, right? So if the government were to ban building on top of OFAC sanctioned addresses, then they're essentially banning Bitcoin mining in the United States, and they're banning running a Bitcoin node in the United States. But if they ban including a transaction in your block or including a transaction in your mempool, you can still operate a mining pool and you can still operate a Bitcoin node. The mining pool would just be foregoing whatever transaction fee revenue is associated with those transactions that are, OFAC sanctioned, which realistically is probably like a tiny, tiny percentage and a tiny source of fee revenue. So I don't think that they would, commercially, it's not like you're saying that U.S. Bitcoin miners would be such a disadvantage that economically that they wouldn't be able to operate in the U.S. Right? It would just like maximum, let's say like 0.1% less top line revenue. And then the Bitcoin node operators, it have zero effect on them that they're not including OFAC sanctioned addresses in their mempool, unless they're the ones that are sanctioned, right? I don't know that, but anyway, that's just neither here nor there, right? So that's where, from my perspective, having filters has zero effect on censorship resistance, because ultimately the OFAC transactions are getting there into the block space and they're getting into the blockchain, whether the US likes it or not, and whether we filter or not. And then the Bitcoin core developers would say, and so what have you accomplished? You wrote all this code to try to filter all this stuff out, and it still got into the blocks mined in Iran. you're still building on top of those blocks because you're not wanting to ban Bitcoin itself, and so you've accomplished nothing. The U.S. compliance officer would reply, "Yeah, but we're not the ones that included the transaction in the block, and so our hands are clean." So like it's just there's not really like there's no resolution to the debate here. I think that you could argue, well, there should be no OFAC sanctioned list, or there should be no requirement for U.S. miners to follow it, or for U.S. node operators to follow it. Sure, yeah, I agree with you. As a libertarian philosophically, that's fine. But it doesn't really get to the question of if we are filtering, are we undermining Bitcoin's censorship resistance? I think no. Are we imposing an unnecessary compliance cost? Yes, arguably. And so that's kind of where I land on it. And that I think pisses off both sides, because the NOTS guys, they're not filtering out OFAC transactions. I'd say maybe that should be a higher priority than filtering out spam if you're trying to comply with U.S. laws. But they would be probably very upset if I suggested that. And I have a position that is really unsatisfactory to both sides. But if we play it fully out, then we have to say, hey, look, Bitcoin exists, it's censorship resistant, all this OFAC stuff is just nonsense, and that the best you can do is monitor OFAC addresses. And this is really where the public policy debate, I believe, has landed, is that if you're operating a Bitcoin exchange and somebody deposits from a OFAC address, then yeah, you freeze those Bitcoin, and the law enforcement gets notified, and then they put it in the Bitcoin reserve. And so that's where things are at. And so if it's funny if an exchange said, hey, we're going to filter out OFAC addresses, then they would say, no, we didn't receive a deposit. We filtered it out. And so, and the government would say, yeah, you did. You absolutely did. We saw it, went to your exchange address. Here it is. And you'd say, nope, we filtered it out. We didn't see it. It's not in our ledgers. So, we're not legally allowed to recognize it. It'd be an absurd situation. And so I think that de facto, the government acknowledges that filtering doesn't work, and that nobody's under any legal obligation to filter out OFAC addresses. And so you could extend that principle out to any other kind of legal obligations.
Yeah, I think that was also very well said. And that's what it seems to be the case to me. It's like filtering doesn't work. Things are still going to get included in the chain that are valid. And therefore, it's just like, it's fun. It's interesting how this argument and division has escalated further and further, despite that I feel like fairly obvious fact to me. But
yeah, and to me then the other argument that gets made is about mining centralization in both directions, right? I think that's the weakest argument. I don't care about mining centralization for the reasons we've pointed out, which is that if centralized miners abuse their power, then guess what? Transaction fees go up, more miners enter, and that's totally fine. I think the strongest argument against filters is having to maintain them. Is the code footprint and the headache of doing that, unless you're actually gonna do a soft fork and actually add it to consensus rules, but you're still then you're still the strongest argument is against them is still the code maintenance of having to deal with that. And that's really a negative externality on the developers. And so, for all the people on Twitter who are saying, we need to have these filters, that's where I'm like, hey, if you want to throw money at knots and spend lots of money on filters, that's your prerogative. Would I recommend people run knots? That's up to them, because I don't think it matters either way. And that's turn off your mempool if it really matters to you. You can turn off your mempool, do blocks only, and that way you're not reeling anything. You don't have to worry about OFAC addresses. You don't have to worry about JPEGs, and you're good to go. You can verify your transactions. You can use your hardware wallet. Cool.
Yeah. I want to shift back a little bit to strategy and treasury companies. I think like one of the deadlines later this week, or potential deadlines, is like maybe it's Friday or a specific day that strategy theoretically could be announced by the committee that they might be including them in the S&P 500 at some point, because they've met all of the qualifications from what I've seen. Yet the committee S&P committee still has to approve them to, and decide that they're going to get included in the index. One, like, do you think that they will get included in the S&P 500? And two, do you think it's a big deal if they are?
I think it's a coin toss as to whether they are or not. I think that the committee could say, hey, look, like, this is obviously not, a typical operating business. This looks more like some kind of leveraged ETF, that it would not get into the S&P 500 no matter how big it is. But I think that would actually that would harm their credibility as a neutral index provider, and that they would have to really think about it long and hard. They could punt on it and say that we're still considering it, but we're not including it just yet. Or they just accept it and roll with it. So maybe due to political pressure too, which is that this administration has clearly staked out a position that it's very pro Bitcoin, and that does S&P want to get on the wrong side of the administration? They're a regulated entity too. They exist at the mercy of the SEC that licenses the NSROs, right? The National Statistical Rating Organizations. And so they're not immune from political pressure as well. So I would say more likely than not, they will approve it.
Yeah. What do you think? It's a huge deal that, passive index fund buyers around the world will all of a sudden have a pretty significant Bitcoin position?
Massive. Very, very big deal. Because, our hope until this would have been that one by one financial advisors decide to add an IBIT allocation to their model portfolio, right? But every model portfolio out there includes the S&P 500. And so just overnight, now we have the whole world of index passive investors, which has really become kind of the most fashionable way of investing, is low cost index funds, and the bulk of them tied to the S&P 500, that would now have indirect financial exposure to Bitcoin success. Great from a number of perspectives. One, the political perspective that now you can't fight Bitcoin, right? If you're fighting Bitcoin, you're fighting everyone. Two is that, we don't want if we use the metaphor of the Titanic of like, oh, we all made it onto the life rafts and like all these other investors, they're going to drown in fiat. No, what we want is everybody's upgrading to a cruise ship and everybody's happy about the new world they're going to. Their portfolio increased as well. Even if they were anti-Bitcoin, they still benefited from it. So Paul Krugman still doing great. We don't have to worry about him. So I think that we want to have a positive vision for Bitcoin, and that this is a great avenue to get there. Even though, from a Bitcoin adoption perspective, people will say, oh, this is not real adoption, right? Because it's not a hardware wallet with your keys and your node. And that's true enough. But if that was the only adoption path that we wanted for Bitcoin, then we do then look at a scenario where lots of people drown without any Bitcoin. And so I think it's much healthier to say, hey, financial exposure to Bitcoin is great because at the end of the day, Bitcoin is NGU technology in addition to being censorship resistant. And really, you know, I'd argue that the NGU technology, it's downstream of the fact that people have the option to run their own node and the option to hold their own keys and the option to mine Bitcoin, right? So if you look at the marketing materials for BlackRock's ETF, they're like, oh, well, the value proposition for Bitcoin is that it's permissionless. While they're selling a product that's permissioned, right? And that's not new. That's not a new paradox, right? So like Coinbase also has been advertising Bitcoin to varying degrees, and that they have a centralized platform, right? Same thing for Kraken or River or Swan. Like, I don't think that there's like a serious paradox that it can't be resolved of, hey, there are low friction, top of the funnel ways of buying Bitcoin that are custodial and that you can continue your Bitcoin journey from there, right? Whether now it's funny, people are like, hey, when are we going to be able to redeem Bitcoin out of MSTR? And my response to that is, you can today. You sell the MSTR and you buy BTC. Okay, it's not a particularly complicated process. They want to have like in kind create redeem, which I don't think will ever exist because it's just it defeats the entire purpose of having kind of that closed end fund. And if we're trading at 1.5x mNAV, which I think MSTR is today, if you redeem, then you get fewer Bitcoin per share than if you just sell the shares. And so it doesn't really make sense. And I think the entire premise of the industry is that even if a stock is trading at a 1x mNAV or less, the idea is that in the future, there's going to be mNAV expansion. And so it wouldn't make sense for the company to say, hey, look, like we're going to have redemptions. No, quite the opposite. They want to accumulate a permanent capital base that they can then intelligently leverage up and to really, you know, be able to grow the company. So all that to say, I think that there's going to be, and I think the way that this makes sense is that if you think about like the trade-offs between holding your own keys and having financial exposure to a Bitcoin treasury company, and then indirectly, right, through leverage to like a leveraged Bitcoin exposure, is really that there's different utility curves at play. So if you're thinking about what's the marginal utility of holding my own keys, one is alleviating the concern of a 6102 of the government coming in and seizing all the Bitcoin held by publicly traded companies or whatever it is, right? At some point, let's say, and you know, I wish this was my situation. It's not, but let's say you've got $100 million worth of physical Bitcoin, and your concern about 6102 is, you know, pretty much alleviated, right? So if you're holding it on your own keys, you got a geographic multi-sig, different jurisdictions. You're not worried about 6102 anymore. Now you're thinking about, okay, how do I continue the Bitcoin revolution, right? Of how do we increase Bitcoin's market share? And you want to be able to intelligently leverage up against your Bitcoin without, you know, having to worry about somebody else holding your Bitcoin. You would rather actually invest in a Bitcoin treasury company at the margin, right? Not putting your whole capital in there. But so like that's, I think, makes a lot more sense than to say, hey, you never have enough physical Bitcoin in cold storage. Empirically, there does seem to be diminishing marginal returns to how much Bitcoin you have in cold storage, just through observing the behavior of individuals in the space. And so, that's where I would push back on that. Now, I would also say that some individuals, maybe their marginal curve is indeed the case that basically they'd never have enough Bitcoin in cold storage, and they have zero interest in investing in Bitcoin treasury companies. And that is a perfectly respectable situation, preference to have, subjective preference to have. But, I think it also speaks to the question of, like, what, if we're being intellectually honest, what is the risk of a 6102 and how do we mitigate it? And this is something that I contended with in the Bitcoin mining industry, where people would say, hey, look, large Bitcoin miners that are publicly traded, like, they're going to have their mining farms seized by the government or shut down by the government, right, by crazy environmentalists like Elizabeth Warren. And so, therefore, if you're doing a valuation of a Bitcoin mining company, you would ascribe an equity value of 0 because you're saying there's a 100% chance that this is going to happen. The Bitcoin mining industry, from talking with its investors and hearing that, hey, there is at the margin a discount due to regulatory risk, rationally invested in public policy and hiring public policy professionals to go and lobby governments to minimize regulatory risk in order to have better access to capital. And so this is just, Adam Smith's invisible hand of saying, hey, look, it makes sense for Bitcoin treasury companies to lobby against 6102, right? And that's, I think, what we'll continue seeing if that was even on the playing field, because in the US, it's not even. Like, I have not yet seen a drafted bill of, hey, let's seize all the Bitcoin from the Bitcoin treasury companies. I haven't heard any rumors of, hey, Treasury's thinking about, doing this or that. Quite the opposite, right? So, and then people will point to, like, Intel, right? Intel, the U.S. government just took an equity stake in Intel, and they can say, well, couldn't the government do that with MSTR? Practically speaking, what would that look like? If it was exactly like what they did to Intel, it would mean that they give billions of dollars to MSTR for them to buy Bitcoin, and then they get an equity stake in MSTR. And then, are you going to tell me that's bearish for MSTR? I would argue not. I'd say might be a buy signal there that they're hand in glove with the government here. It's like don't fight the Fed. It applies here of like, hey, clearly the administration wants to pump MSTR. They want to pump Bitcoin. So get out of the way and go, gig along. And so I think that those concerns are either overblown or they're not really thinking about, like, what's the game theory long term of, how much lobbying is going to happen. And I would argue that the reverse will happen. I think, and maybe the reverse has already happened of Bitcoiners taking over the government. And so that's where I think the game theory is going.
Yeah, if you're not holding Bitcoin at this point because you think the government is going to ban Bitcoin or confiscate Bitcoin, you've made a losing bet for quite some time, I think, at this point, and it's not going your way. Since you wrote a post on the Nakamoto Institute called "The Speculative Attack," and now you have Strategy issuing their preferred equity, and specifically STRC, which is like a money market dollar IOU. Do you see similar? Like, is this your idea playing out, in real time, or the blog post that you wrote? Is it playing out in real time right now? And how do you see this playing out, going forward?
It is. So I think this is a textbook speculative attack that's playing out. And in the post, I did humbly suggest that I don't know exactly how the mechanics are going to play out, but people are going to leverage up and go long Bitcoin. What I really should have included in there that I did not have the foresight to include, and that has surprised me, is what asset they leverage up. And really, this should not have surprised me, right? I'm like, well, they're going to leverage up against their home equity or against their business equity, against the operating businesses. I didn't really foresee that they would leverage up against Bitcoin itself, which rationally, it's like, why would you hold other forms of collateral that are going to underperform Bitcoin just to leverage up and go long Bitcoin with the leverage? And so I kind of should have seen that coming, which is, that they would prefer to use Bitcoin as collateral rather than any other asset out there. Back in 2014, that just seemed like science fiction, I suppose, or just, so inconceivable that you could borrow against Bitcoin. I think that's where we're at. I wrote a follow-up to Speculative Attack, Part 2 with Alan Farrington for Axiom BTC. And we look at, since I wrote that piece in 2014, 10 years later, so we wrote this a year ago, kind of where are we at? And so we pointed out El Salvador and what they're doing with their reserve, and what strategy is doing with their reserve, and with their treasury policy. And so, and the borrowing against it. And so I think that this trend will continue. It will accelerate. It will amplify. I think that now that, when we think about leveraging up against Bitcoin, we want to be careful because of the reflexivity. If you can get liquidated and you're forced to sell your Bitcoin at the worst possible time, that's terrible. Bitcoin's a very volatile asset. And so leveraging up against it is very risky business. So, saying, we're going to have a convertible bond that's not due for several years. Okay, so you're de-risking it quite a lot because it's non-recourse. So, even if the Bitcoin price crashes, you don't have to immediately sell the Bitcoin to pay off the convert. You do have the refinancing risk. And so that's where Saylor was like, let's do perpetual preferred so we don't have the refinancing risk. And then you have duration matching between the asset side of the balance sheet and the liability side of the balance sheet, which is very good from a corporate finance perspective. And so that means that now we can have a kind of instead of having this manic speculative attack process of, hey, let's go 100x leverage on BitMEX and then, get wiped out, or on Bitfinex, going back even further. Now let's go leverage long on these perpetual preferreds so that we don't get liquidated in a bear market. In fact, we can continue to buy in the bear market, and that it's a long-term speculative attack rather than a short-term one. And so I think that combine that with, we no longer have the halvings as material relative to the trading float of Bitcoin. Maybe we're past the 4-year cycles. And so maybe we're in a completely new territory for Bitcoin's exchange rate, and that it's going to be shocking to people, and they're going to be very surprised when we don't have that 80% drawdown after a blow off top. Instead, we just have this very boring sideways, 6 months up, 6 months sideways, 6 months up, 6 months sideways, and people are just losing their minds of why aren't we going parabolic? Why aren't we crashing? And they're getting wrecked in either direction. But the people who are really playing the long game, they're going to really benefit from the spread between the cost of capital, which for STRC is 10%, and then Bitcoin's CAGR of anything greater than 10%, right? Historically, recently, it's been, let's say, 20 to 50%. That's going to be a very nice spread for the equity to capture. And I think that it's going to be a completely new market structure that we're in.
Yeah, I think you might be right there. Pierre, we can start to close it out. This will be one of the last questions. I'm curious, what's going on with the Bitcoin Bond Company? And I know you're also hosting the Bitcoin for Corporations podcast. How are those two things going for you?
Yeah, no announcements today for the Bitcoin Bond Company. Continuing to work in the background on wrapping Bitcoin in credit securities. Then on Bitcoin for Corporations show, we've been hosting different leaders from the industry. Joe, hope to have you on soon. to represent Semler and what y'all are doing, and encourage people to go check it out and to see kind of what the whole ecosystem is doing. And yeah, so I'm excited about the treasury companies as a whole. That it's going to continue to grow. Really excited to see you at Semler and Natalie Brunell as well. You know what? We had Semler CEO on the Bitcoin for Corporations podcast in a prior episode, so I'd encourage folks to go check out that episode and to get up to speed on what Semler is doing.
I love it. Well, Pierre, thank you again for your time. And then I'm happy to come on at some point in the future as well when you need a second update from Semler. But yeah, thank you, Pierre. This is great. It's always great to catch up and talk Bitcoin. Thanks for coming on.
Thank you for having me, Joe. Bye.